Welcome to Real Estate in Real Time. I'm Woody Zimmerman here with Mark Skibowski of Remax Lakes. Welcome to the show.
Here we are, morning.
Good morning. And, I get asked this all the time, only because I've got a couple of rental properties and so forth. So I talk to people in the business and people are always talking about, hey, the crash is coming. There's going to be a bunch of foreclosures. It's going to be a great time to buy. I'm not really seeing this crash coming, and we've been talking about that for quite some time.
Yeah, we have, because you've got the folks, hey, I'm going to wait until the market number one drops, which is not going to happen anytime soon. That's Mark's prediction. Write it down, check it off.
Yep.
Not going to happen anytime soon. I'll wait. There'll be foreclosures coming. Well, the market data doesn't show that. I can tell you locally, there are very few to none that are foreclosures available for sale. There's limited opportunities for anybody that's thinking, hey, I'm going to buy a foreclosure and flip it. The other thing that I would say is foreclosures back in the day, and when I say back in the day, that 08, 09 time frame, banks would do basically nothing to the houses. I mean, they could be in really rough shape, and they would come on the market giving you an opportunity to buy at less than market.
Right.
To make some repairs and turn around and make some money on the flip side.
Okay.
Right? And HGTV with all these flipping shows.
Oh, yeah.
Flipping, you can use that term however you choose to.
Yeah, right.
There are so many of those shows that are just not realistic in today's marketplace, right? In Kosciuszko County, the number of foreclosures that are out there and available are slim to none. There's just not many happening. Maybe in some of the bigger cities where you've got more homes that are out there, but in Kosciuszko County, limited opportunity for foreclosures. The second thing that banks learned out of the foreclosure crisis of 08, 09 is that if they put a little bit of money into them, they can get a better return on their investment.
Oh.
So 08, 09, they did nothing. I mean, it was amazing.
Well, there was so many of them.
There was a lot of them, and it would have cost a lot to get them up to speed.
Yeah.
But they were leaving money on the table by not making any repairs.
Yeah.
And I did foreclosures for Bank of America. When I say did foreclosures, meaning I would go out and do broker price opinions. This is where we should price the house given its current condition.
Yeah.
And then I listed those for sale. Worked with a lot of people on the buy side of, a lot of foreclosure properties, got scared in a lot of homes because it's amazing what people do when they've lost their home. They're in a, distressed state. Some of the way that people leave the properties when they go, it's scary.
Yeah.
Banks would basically do nothing. I mean, I went into a house in Mentone one time that I came out and I had fleas all over me. I mean, it was, the carpet was so bad. I stripped my underwear in Mentone. This was downtown. Because I'm like, I'm not getting in my car with these things all over.
Yeah.
I threw the pants away, strolling around in my tidy whities.
Yeah, right. Walking home, or coming home, Terry's like, where you been?
Exactly. You can't unsee certain things.
Yeah.
There were probably neighbors that were, what the heck? This guy's running around naked in our neighborhood.
Yeah.
But there were a lot of things that banks have learned through that process to where if they do a few repairs to them, they can turn around and sell them at a much better price than they would in taking the loss as they were there. And many of them were insured. It didn't really matter, but they also limited their market. If they didn't make the repairs, they couldn't sell to the people who would be buying in that price range.
Yeah.
So if they fixed them, they could sell them USDA, FHA, lower down payment conventional versus just a cash payment.
Yeah.
So that was in the heyday of foreclosures. We are not in that place now. So why aren't there any more foreclosures? Economic conditions, while we're complaining about inflation and things are high and this, that, and the other thing, a lot of people have a lot of equity in their homes. And it's unlikely that they are going to walk away from that equity in their homes.
Yeah.
Right? The reason that a lot of people would just say, the heck with it, I can't make the payments, is they had bought with low down payment, no down payment. Seller paid all their closing costs. They didn't have any skin in the game on the houses. Now, I'm not saying all. There were people that lost their jobs and, they did have equity in the house and they lost everything when their homes went to foreclosure. But the mortgage crisis actually was that 08, 09 was They were giving loans out that, were you breathing? Yep. Do you have a pulse? Okay, we'll give you a loan.
Yeah.
That has all changed. In fact, now it's tough to get financing because they look so closely at you. Doesn't mean you can't. It's not anything that's so extreme because we do get a lot of mortgages. We sell a lot of homes. Mortgage brokers, lenders have to approve mortgages.
Right.
But the restrictions that they put on them, and when we talk about getting ready to buy a home, having cash reserves, having money in the bank left, having your own money to pay for closing costs, those are all different than back in the mortgage heydays of 08 and 09 and that foreclosure crunch. Because I got to tell you, people were buying that should not have been buying houses.
Yeah.
They were buying lenders, because the regulations were such. To where it was okay for them to do it. All those things have tightened up. So the restrictions on borrowers have changed a lot. And part of that's leading to the fact we're not going to see as many foreclosures because the loans that they wrote were better loans.
Yeah.
Even when the economic conditions change, they were better loans to better buyers. Unlikely they're going to walk away from the equity that they have in their houses unless something gets really, really bad.
Yeah.
And we're not really, really bad at this point. High inflation, but not really, really bad as we were in 08 and 09.
Yeah, and we do have to talk about interest rates as well.
Yeah.
So we're going to talk about that next. You're listening to Real Estate in Real Time. Yep. Welcome back. You're listening to Real Estate in Real Time. Woody Zimmerman here with Mark Skibowski, and we're talking about this whole foreclosure thing, and we're not seeing, there's not going to be like a bunch of foreclosures like we had back in 08 and 09.
No, I don't believe we're going to see a rush to that. Part of that is due to the lending practices and while we as agents really dislike that process because none of us like change.
Yeah.
Right? Because it did change how we had to do business.
Sure.
It changed for lenders how they had to do business. The disclosure requirements changed. It many times you had to prove where every deposit came from. I mean, it can seem, hey, you're intruding on my life. But the fact is, the lenders want to make sure that it's a good loan.
Oh, if I get an extra $1,000 in my bank account, where did that come from?
Where did it come from?
Yeah.
You have to document all of those things. And it's actually a good thing.
No, it is. It really is.
And if you're not buying a home, you don't have to prove anything to anybody.
Right.
But bottom line, if you want to borrow, if you want us to give you this money, these are the things that we need. Right? And I'm just as, private as anybody else. I don't want to give my information away. But if I want you to loan me the money that I need in order to do this, this is what I need to do.
Right.
So make that decision. Large deposits, have got to be documented. Where did it come from? Well, I sold a jet ski and I got cash for it. Where's the bill of sale to prove that you sold the jet ski?
Right.
And what are the lenders looking for? Are you getting unsecured loans? Are you borrowing money to put into your account to do it that ultimately you have to pay back?
Yeah, because they don't want you to be leveraged.
Exactly. That's additional debt.
Yeah.
That's additional debt. So, right now, interest rates, they're bouncing around like nobody's business. And I think I've mentioned it before. I get weekly updates from different lenders. The latest and greatest, 7 3/8 on a 30-year fixed for a good qualified buyer.
Wow, that's up.
That isn't, low credit risk. That's a well-qualified buyer, 7 3/8. Not too long ago was 6.5. Now, just because I'm saying this rate on the air today doesn't mean that's the rate that you're going to get.
Right.
Because they fluctuate throughout
all
the day.
Time.
They're all the time. Every lender has a different program process, all of those things. They've got a way, they can tell you what your rate is. So talking to a local lender will definitely be your best source to figure out, I'm thinking about buying, what's my interest rate going to look like? Now, if you don't lock that rate, it could change between now and when you ultimately do lock your rate.
Yeah.
And I can tell you there are transactions that are falling apart, and we've got a clause in the purchase agreement that says the interest rate, it's a not to exceed interest rate.
Okay.
So it's a section on financing where we put in there at an interest rate of X. And many times I add 1/4 point to that. So if somebody's got a quote from their lender for 6.5, I put 6 3/4. So if the rate fluctuates, it's fine. But if it goes to 7, that may make it to where they can't finance. So that's a not to exceed rate. And we're seeing that happen more and more to where interest rates are so volatile, to where somebody gets a contract in 30, they don't lock their rate till the end. that rate may jump. So that's why it's even more important to have that discussion with your lender about how your loan process, how the home buying process, are we through inspections, are we through, we've got the appraisal back, doing it in a shorter window, so you don't allow for that additional fluctuation.
Yeah, so they raise interest rates to slow down inflation.
Yes.
But it feels like it's inflation. I mean,
Yeah,
you know what I mean?
does. It does.
So what's that going to take, though?
Yeah.
What's it going to take to get these back down? I mean, it's hard to say.
I don't know.
Yeah.
There's a lot of smart people that are trying to figure that out, and sometimes you think there's a lot of dumb people trying to figure it out. But the reality is, what the Fed's doing is going to impact us.
Yeah.
It's going to take a little bit of time to get there.
Yeah.
So there are about 92% of the homeowners today are at 6% or below on their interest rate. Now, I pulled these stats. 80% of the loans are below 5%.
Okay.
That are current mortgages that are out there.
Right.
30% are 3% or below.
Yeah.
So when we're talking about foreclosures, unlikely you're going to see that. These people are not paying the higher interest rates that we're seeing today.
Yeah. Okay.
They're locked in at a significantly lower rate, which goes back to the shows we did years ago. How do you fix your rate? How do you fix your housing expense? You get a 30-year fixed rate mortgage.
Yeah.
And when rates were 3%, that was the time to do it.
Yes.
Right?
Right.
Unlikely those, which is adding to our inventory crisis, the fact there's no inventory on the market for people to buy.
Yeah.
But this show is about foreclosures. Those people have probably built a lot of equity into their home.
Yes.
They're not going to just walk away from it.
No.
They're not, unless something drastic happens, they are not going to allow themselves to get into that position to where the bank is going to foreclose on them. So again, we're not going to see a big jump in the number of foreclosures that are out there. Are we going to see interest rate fluctuations? Yes. Are we going to see a lot of inventory jump on the market? Probably not. Home builders can't build them fast enough, and they're building them at a higher price, at a higher interest rate. So long term, that cost is going to be higher for somebody there. However, even at that higher interest rate, at a higher price, you're better off than renting. You're better off than paying rent. And I did see a meme on Facebook, in the last week that said, it's a split screen, and it said, well, interest rates are 7%. I'm paying 7% towards, interest. Oh my God, it's terrible. The other side of the screen says 100% of your rent goes away. You're not building any equity. Right. So it's a bit extreme, but
well, yeah. So a lot of people say with interest rates, is it a good time to buy? Well, sure.
Right.
Anytime's a good time to buy when it comes to your why that you always preach.
Correct.
And when interest rates do drop, because they will drop eventually at some point, that's when you refi.
When you refi, again, it's setting yourself up for financial success long term.
You can continue this conversation with Mark. Reach out to him. Mark, what's your contact info?
Website, skibowskiteam.com. Phone numbers, 574-527-0660.
All right, very good. You've been listening to Real Estate in Real Time. Have yourself a wonderful weekend.